Mega cap stocks dominated 2024, creating very nice returns for anyone that was invested in the Nasdaq 100, anyone who followed that S&P 500. Unfortunately, those financial trends do not last and really go on forever. Many analysts believe that the mega growth could take a pause in 2025, even pausing as far as 2026, meaning the growth for these years might not be there and leaving a lot of room for other market segments and other stocks to really take the lead. Now, if you look at these predictions in today's video, we're going to be breaking down and looking at exchange traded funds, looking at those ETFs that you can invest in kind of a set it and forget it portfolio, looking at 5 that really do make up the entire market and creating that entire portfolio with a lot of diversification. So let's go ahead and break down these 5 ETFs. Now, the first one we get into is the VTI, which is the Vanguard Total Stock Market ETF. Now, this encompasses the stock market in its entirety. When we start looking at everything that it covers, you are talking about large cap, small cap, mid cap, micro cap, very low expense ratio, making it super cost efficient. And there's a reason why when you start breaking down a lot of these ETFs, the ETFs have the ability to outperform a majority of financial advisors because they have historical strong performance and they have done incredibly well. Breaking it down, kind of an overview of what this looks like and how the performance has looked over a very summary. So month end, of course, a little bit down. This is as of December 31st, 2024. And all of these charts are for that exact same time frame. Looking at 3 months, we're at about 2.6%. When we start looking at our year to date, we're at 23.71. That is right. In the last 12 months, year to date, it's kind of crazy. We're looking at 23.71 last year for the total entire stock market itself. And then, of course, since inception, we're looking at 8.89% rate over here, which is still a pretty good growth. Thinking of the last essentially, 24 years since the inception of the VTI from Vanguard, that means we've seen the housing market crash. We've also seen, COVID. We've seen some ups and downs in the stock market and overall posting almost a 9% return. Now, this, of course, could make up roughly 20% of a portfolio being invested in the total stock market. Now, this is also an ETF that I do personally hold in my portfolio. It is actually in a portfolio that I generated and built for my kids. And the other big one with this is when it comes to these expense ratios, guys, when you look at the expense ratio and it's 0.03, that is incredibly cheap, but it is a passively managed ETF, meaning isn't anyone that is changing it. So as it evolves, as companies come into the market, as companies go out of the market, as companies go bankrupt, most of these will just go ahead and automatically change because they are following the index that they are tied to, making sure again that you do have a lot of really diversification when it comes to an ETF like this. Now, when we take a step back and thinking of VTI, the next one we look at is VT. This is the Vanguard Total World Stock ETF. So when you think of the VTI, it covered all of the stocks that were available within the United States markets. When you start looking again, kind of a bigger picture, this is covering the entire world. This is every publicly traded company, both international and global stocks, that make up this index. Now, of course, it does have a little bit higher of an expense ratio, but I want to break down the performance in this one because as you can see, month end about the same. We've seen a negative 3% in the VTI. Looking year to date, 16.44. So that tells me right there, when you compare the VTI to the VT, that the US markets did a lot better in the last year than we're seeing in the global markets. So it is bringing it down a little bit when you start investing into everything. And even when you look since 2008, since the inception of this fund, which of course is 7 years later than we've seen the VTI, overall sitting at 7.63%. And then of course the expense ratio in here is 8.07. Now, the big thing with owning this, which again, if you have it in a 20% portfolio, is you have 20% invested into the Vanguard total market. So you're investing everything into the US. This is giving you a lot more exposure to the international stocks and the international markets with holding something like the VT, the Vanguard Total World Stock ETF. So you're really broadening again when it comes to diversification, when it comes to being able to, when global markets outperform the US markets, or the US markets see a very big downturn, they could essentially be carrying it the other way, where again, in 2024, the US markets did incredibly well. Global markets were a little bit behind. We could actually see that flip-flop in the upcoming years, depending on how much growth we do see out of there. Then we get into the bonds. Now, the bonds, this is the BND, the Vanguard Total Bond Market. For a lot of people, bonds are the way to go, even thinking of Warren Buffett in bonds. Me personally, as much as I look in a portfolio, and again, putting 20% of that portfolio into the BND, my thought with bonds is, you get a lot of stability. It's a lot more stable than stocks are. However, it doesn't seem like there's as much as a return, which we'll go ahead and look at. So looking at the performance, you can see month end a little bit negative, even 3-month total negative 3%. Year to date, we're looking at 1.36. And again, this closed December 31st of 2024. So thinking of a year to date, you made 1.36% in the last 12 months, meaning everything else within the stock market would have absolutely outperformed. But then when we start looking at a bigger picture, looking at even the 3-year and the 5-year, the 3-year and the 5-year are both negative. Thinking of the last 5 years in the market and how incredibly well it did, even looking in comparison to like a VTI, in the last 5 years, we're up 13.81%. Versus the BND, which is down essentially a 0.33 since inception. So we're looking at 2007. So we're roughly running about 18 years here and has yielded a 2.9%. Now, for a majority of individuals, if you've been in financial institutions, if you've seen other places, high yield savings accounts are paying much more than that. We are also seeing a lot of CDs that are paying a lot more than that. So me personally, I do not invest in bonds as much as my financial advisors, individuals that I work with recommend me putting money into something like the BND or having some exposure to bonds. I really don't see the value. I know there might be some down years in the market where it might be a little bit more of a struggle, but I'm looking more, a lifetime portfolio that is kind of a set it and forget it. Don't have to keep adjusting. Don't have to keep buying and selling out of ETFs. I just want to go ahead and put money into it, make regular contributions, and have it grow in the entirety. But again, a lot of financial advisors still do recommend the BND or bond funds in general. And then, of course, this is one that I thought and really had to put some time and effort into is the Vanguard Real Estate ETF. Now, for me personally, these are REITs. It is the VNQ, as you can see. This is in real estate. So this is domestic stock sector specific. This falls into the real estate. So you're getting out of the realm of stocks. You're getting out of the realm of having bonds, but you're getting into the realm of real estate itself. When you look at the expense ratio of 0.13, so a little bit higher of an expense ratio. And overall, you can see it's been a tough year, month end at negative 8%, 3-month, even looking at a year to date total, just under 5%. But then we start looking at a 3-year, which again, when you're going back to just kind of the post-COVID, 5 years at about 3%, 10-year is at 5%. And then since the inception, so in the last 21 years, it's 7.51%. And of course, if you remember, since 2004, we did see the housing market crash in 2007, 2008. So there has been a lot of different events that have kind of happened. But if you're looking into getting into and having a little bit of exposure into real estate, this would be the way to do it. Now, there are really 2 different ways to hold real estate. Number one is holding the REITs like we see here, actually holding the ETFs, holding the stocks that own the real estate. I know Realty Inc., I believe that the ticker symbol on that is O, is investing into real estate and getting into real estate on the investing side of it and the investment portfolio side of it. The other side of real estate is, of course, owning physical property, owning houses, owning rental units, owning apartment, owning industrial buildings, actually physically owning the property itself. For me personally, that is never something I wanted to do. I don't want to be a landlord. I don't want to deal with all of the headache. I know there can be an incredible amount of return with that, but overall, I choose and really opt out of the real estate aspect because of just the turmoil and the things that I've seen being in the financial institution with everything that it comes with the real estate. And the final one we're looking at is the US Aggregate. Now, this is the one from iShares by BlackRock. This is, again, another bond ETF. So when you think of this portfolio, and again, thinking kind of big picture, putting 20% in that VTI, 20% in the VT, that gives you exposure to everything in the US market, also gives you exposure to everything in the global market. Then 20% into the BND is giving you to the total bond market, which again, having exposure to bonds. We have that VNQ, which is the Vanguard Real Estate ETF, which is giving you exposure to REITs and real estate in general. And then we finish it off with the US Aggregate Bond ETF. Now, this one, of course, is just like it is broad exposure to US grade bonds, cost efficiency, core fixed income solutions to keep more of what you earn. Now, this for me, again, thinking of the bigger picture of holding bonds and holding bonds in this manner. You can even see cumulative, on the 1 month, we're a little bit down. 3 months, same as what we've seen with BND, it's a little bit down. But then we start looking at the 6 month, even the year, we're at 1%. 3 years negative, 5 years negative, 10-year goes to 13.93. So pretty good return in a 10-year. And I want to go back and just look at some of the other 10 years that we've seen. But overall, again, this is a recommended portfolio or recommended build from a financial advisor that, of course, has a lot more knowledge that I do about investing. But overall, for my opinion, in the way that I see it, I do not invest in bonds, like I said earlier, and I do not invest, and if I do in real estate, it would be REITs. But looking at 10-year, we're at about 13%. But even coming in here, 10-year, 12.5. So the bonds, we're doing incredibly well because remember, for a period of the last 10 years, we did have incredibly low interest rates. So I don't even know if anyone is going to beat out the 10-year. Right there's 9, even 10 years. So look at the difference, guys. Between the BND, the Vanguard total bond market, we're at 1.3. The aggressive bond ETF is at 13.93. That is an incredible return that they really had from iShares. Now, of course, also when it comes to these ETFs, you can have a ton of variations from it. Doesn't have to be all the Vanguard funds, doesn't have to be iShare. Majority of companies will have very similar funds, and a lot of companies will have ETFs that track the exact same markets as we see with the total stock market index, that VTI fund that does track the entire index. So guys, you don't have to stick with the Vanguard funds. You don't have to stick with the iShares. You can go out and pick whatever companies that you want to. And if you want to start investing, if you're brand new to it, definitely look down below, guys. I have a link down there for Robinhood. I also have one for M1 Finance if you're interested in investing in it. But guys, that is going to do it for the 5 ETF portfolio. Very, very cool to break it down and really see some of the ins and outs of everything. Like I said, me personally, I don't invest into bonds. It's something that I choose not to do. Same as real estate. I do not. I am in the stock market. I have the SCHD. I own the VOO, the Vanguard S&P 500. And also the NASDAQ. So I know both of them kind of have an overlap. That's my portfolio. And we do have that exposure to Bitcoin that we've seen in our last video. So again, that's going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.